Most people assume car dealerships make a fortune every time someone drives off the lot. New cars cost tens of thousands of dollars. Showrooms stay busy. Financing feels complex. The buildings are large and expensive. It seems obvious that selling cars must be highly profitable. In reality, many dealerships make surprisingly little money on the cars themselves. Some lose money on individual sales, others barely break even. The profit most people imagine is often coming from somewhere else. The core tension is simple. Dealerships sell one of the most expensive consumer products people buy, but they operate in a market where prices are largely fixed, competition is intense, and margins on the core product are thin. Volume matters, but volume alone does not guarantee profit. Car dealerships sit between manufacturers, consumers, and lenders. They are the public face of the auto industry. They handle inventory, sales, trade-ins, financing paperwork, and service relationships. Because of that visibility, they are often assumed to capture most of the value in a car sale. The reality is far more constrained. Dealers do not control pricing the way many people expect. Manufacturers set suggested retail prices and heavily influence incentives, rebates, and vehicle allocation. When a new model launches and supply is tight, prices can briefly rise. Once inventory normalizes, competition between nearby dealers quickly pushes prices down. Dealers compete against others selling the same vehicles, often within a short drive. Online listings make comparison easy. Customers can see dozens of identical cars in minutes. That transparency limits pricing power. To move inventory, dealers discount aggressively, sometimes to the point where the sale itself produces little or no gross profit. Inventory pressure compounds the problem. New vehicles arrive according to manufacturer schedules, not dealer demand. Floor plan financing, the credit dealers use to hold inventory, accrues interest over time. The longer a car sits on the lot, the more it costs to carry. That shifts incentives toward turnover rather than margin. Selling quickly becomes more important than selling profitably. Used cars offer more pricing flexibility, but they introduce different risks. Acquisition costs fluctuate, trade-ins can be misjudged. Auction prices move rapidly. A vehicle bought at the wrong moment can lose value before it sells. Reconditioning adds costs that are difficult to predict. Used inventory ties up capital and increases exposure to pricing mistakes. Operating expenses intensify these constraints. Dealerships are capital-intensive businesses. Real estate is expensive. Facilities must meet manufacturer branding standards. Sales staff earn commissions. Advertising is constant. Technology systems, compliance requirements, insurance, and utilities create fixed costs that do not fall easily when sales slow. Because of this structure, selling a car often functions as an entry point rather than a profit center. The transaction establishes a customer relationship. The economics improve after the sale. Financing is one source of that improvement. When a dealership arranges a loan, it may earn a portion of the interest spread or a flat fee from the lender. This income is smaller than many assume and increasingly regulated, but it can turn a low-margin sale into a modestly profitable one. Without financing income, many new car deals would be unattractive on their own. Extended warranties, service contracts, and add-on products play a similar role. These items carry higher margins and are sold after the vehicle price is largely locked in. Acceptance rates vary and regulation limits pricing, but they remain an important part of dealership economics. Service and parts departments often generate the most stable profit. After a car is sold, it returns for maintenance, repairs, and warranty work. Labor and parts margins are higher than vehicle margins. Service revenue is recurring and less sensitive to pricing cycles. In many dealerships, service subsidizes the showroom. This structure becomes clearer when examining large dealership groups. AutoNation offers a useful case study. It operates hundreds of dealerships and publishes detailed financial results. While total revenue is dominated by vehicle sales, a disproportionate share of operating income comes from service, parts, and finance-related activities. AutoNation's disclosures consistently show thin margins on new vehicles. Gross profit per vehicle fluctuates with supply conditions, incentive programs, and demand. During periods of limited inventory, margins improve briefly. When supply returns, margins compress. The pattern repeats. A clear inflection point occurred during the pandemic. Supply chain disruptions sharply reduced new car availability. Inventory fell to historic lows. Prices rose. For a short period, dealerships experienced unusually high margins on new vehicles. Many assumed this reflected a permanent shift. It did not. As supply recovered, competition returned. Pricing pressure resumed. Margins moved back toward historical norms. The episode revealed how dependent dealership profitability is on temporary imbalances rather than lasting pricing power. The broader lesson extends beyond car sales. Dealerships operate as intermediaries. They carry inventory risk without controlling production. They compete in transparent markets with limited differentiation. They absorb fixed costs while revenue fluctuates with economic cycles and interest rates. Even high volume does not eliminate these constraints. Selling more cars increases exposure to inventory costs, staffing needs, and operational complexity. Scale helps, but it does not change the margin structure. Growth magnifies both opportunity and risk. This is why dealership ownership often appeals to long-term operators rather than pure retailers. Returns depend on diversified revenue streams, disciplined cost control, and favorable market timing. The sale of the car itself is rarely the main source of profit. From the outside, dealerships look like obvious winners. They sell expensive products. They appear busy. They occupy prominent locations. Inside, the business is a constant balancing act between volume, financing, service, and cost management, with little margin for error. In the end, car dealerships show how visible revenue can hide fragile economics. High prices do not guarantee high margins. Control over distribution does not guarantee pricing power. Selling cars is essential to the business, but it is rarely where the business truly makes its money.